In the last few months, many well-known investors and speculators like Warren Buffett, Buffett's longtime business partner at Berkshire Hathaway, Charlie Munger, and hedge fund manager George Soros have come out in public to advise people to stay away from gold. They have called it all kinds of names, made politically incorrect references to scared Jews escaping Nazi Germany, and they love to keep repeating the phrase John Maynard Keynes used that many current mainstream economists and Wall Street talking heads educated in business at large universities also like to use, that gold's a barbarous relic from centuries past with no real intrinsic value. George Soros is doing his usual politician-like antics, where he is doing one thing while saying another that completely contradicts what he says. Hypocrite, anyone? In this case, Soros publicly bashes gold and tells the masses they should not own any exposure to it, and then Soros increases exposure to gold by more than 400% in his hedge fund just in the last few months. Today, I would like to specifically take the time to analyze why Warren Buffett hates gold so much and why Goldseek Radio listeners shouldn't bother listening to him, especially considering Buffett's horrible track record of investing in the natural resource sector. In the natural resource sector, Buffett is definitely not an expert. Buffett began accumulating physical silver over a decade ago on the LBMA in London. He accumulated over 100 million ounces of physical silver bullion and sold out of his position before silver began to dramatically move higher into the double-digit price range for only a tiny profit on a percentage basis. Buffett also bought his ConocoPhillips position, which is considered one of the worst mistakes of his career, only shortly before the WTI oil price crashed from $148 a barrel and the U.S. natural gas price crashed from $16. Buffett lost more than 70% of his on his Conoco position. He bought high and sold low, which is the exact opposite of what people should be attempting to do, and which goes against Buffett's contrarian value investing philosophy on every level. Like many value investors and contrarians, I respect Buffett's valuation formulas greatly, but I don't care for Buffett's political views, and now I really don't care for the fact that he bashes owning gold when the world is in arguably the worst macroeconomic situation in history, when money can be created infinitely with the stroke of a keyboard at a central banker's whim. For those of you not aware, Warren Buffett became an adult right at the time Keynesian economics was being widely accepted by academia in the 1920s and 1930s. Buffett went to graduate school at an Ivy League school in New York City at Columbia University to learn under legendary investor and fundamental analyst Benjamin Graham, where he learned the valuations that built his entire successful investing career analyzing companies that were undervalued compared to future earnings growth. However, many of you were probably not aware that Buffett also was one of the first groups of college and graduate students to learn Keynesian economics, as Keynes's general theory had recently been released. According to one of Buffett's biographers and daughter-in-law, Mary Buffett, who has written many Buffett books, including all of the well-known Buffettology books, Keynes and his teachings became a personal role model to Buffett. In fact, besides Benjamin Graham, Keynes was and still is one of Buffett's main role models. It is in this respect for Keynes and his views that Buffett's hatred towards gold and the quote-unquote old ways was built. These are deep-rooted views Buffett has about gold going back literally to when he was a young man learning Keynesian economics. The problem is that in a lot of ways, many mistakes of the 1920s and 1930s are being repeated again, as the world is now in one gigantic currency war where each country tries to devalue its currency against its trading partners for competitive advantage. Purchasing power savings is not being held in sovereign debt, currencies, and many asset classes, as they all lose purchasing power to the real inflation rate. If assets are not keeping up with or beating the real inflation rate, and they rise only in nominal terms, then in a non-Austrian school definition, assets are deflating in terms of purchasing power. But what are all asset classes losing purchasing power to? The answer is clear, but Buffett, other Keynesians, and many deflationists refuse to acknowledge that another form of money, gold, has gained against all major asset classes now for over a decade. Gold has gained purchasing power against regular stocks like Buffett's Berkshire and the Dow and S&P 500, real estate, and also against other commodities like oil. For someone who loves to invest in insurance companies and to buy option insurance on some of his stock positions, Buffett chooses to disrespect and not understand the ultimate form of insurance, physical gold. Physical gold is one of the only forms of insurance that does not have counterparty risk in our paper financial system. For someone who supposedly understands the insurance business and that buying insurance for your business, your investment portfolio, or yourself does not provide cash flow and that it is not value added, Buffett appears to not understand or pretends to not understand that gold is not insurance. Gold does not have to provide value added in an environment where there is no risk-free rate of return due to sovereign debt risk and inflation risk. When people are getting 0% to park in cash or debt, then why hold those instruments when there is many significant forms of risk making these anything but risk-free? And yet Berkshire Hathaway has lost more than 70% of its value in the form of purchasing power relative to gold as Berkshire struggles to barely even keep up with the Dow because of its massive bank exposure. Warren Buffett is a great investor, but his investing style works best when inflation is low or non-existent, unlike the volatility and stagflation we have in the real economy now, where inflation is wreaking havoc globally on consumer staples, insurance, food, energy, and other input costs for real businesses and the consumers who need to also purchase these products on a daily basis. Buffett's style of investing assumes that his consumer monopolies higher up the value chain will be able to pass along all input cost increases to consumers. But in this environment, businesses are eating a lot of the costs and only slightly raising prices and or reducing portion sizes. In other words, profit margins are being compressed and profits are being squeezed smaller. The conference calls from companies and what they are saying about profits, higher input costs, and inflation prove Buffett is wrong about his views of stocks higher up the value chain being the safest inflation investments. In conclusion, if you're looking for good investing ideas for non-resource company dividend stocks, listen to what Buffett has to say about companies. But don't listen to a word Buffett has to say about resource stocks and specifically gold. He's a Keynesian gold hater, just like many others in the mainstream. It's refreshing to hear other well-known and respected value investors like David Einhorn have the courage to come out in public and challenge Buffett and Munger on their views about gold. I have a lot of respect for David Einhorn for having the courage to speak up to Buffett in public when he knows Buffett is wrong about something and to challenge someone with Buffett's track record. After this commentary, I think Gold Seek Radio listeners will agree that Buffettology will never mix with gold. For more commentary on the economy and the markets, please check out wallstreetformainstreet.com at WALLSTFORMAINST.com.